Hello and welcome to video number 4 of the Aerial Effects Beginners Course series. And in this video we're going to be talking about the concepts of leverage and margin. Okay, and how these concepts actually allow us to make money, to make a profit from our phones in this market. So what is leverage? Well, leverage is having the ability to control a significant amount of money using only a small amount of your own money. Okay, so in kind of describing this, used to, you would have to have a very large amount of money, hundreds and hundreds of thousands of dollars, to actually make a profit in this market. Okay, we trade and we make money based off the fluctuations in the exchange rates between different currencies. And these fluctuations are often pennies or cents. Okay, and so you would have to have a large amount of money invested as a position size in the market to be able to actually make a profit off of the tiny fluctuations in the exchange rates. Now, brokers allow what is called leverage and the use of margin. Okay, so leverage allows us to control a large amount of money, a very large amount of money, using only a small amount of your own money, putting up only a small amount to take control of a lot. And leverage is expressed by your broker in ratios. So oftentimes brokers range from 1 to 100 to 1 to 500. What that means is you're putting up, for every $1,000 of your own money that you put up, the broker is allowing you to trade as if you had $100,000. Okay, so you're taking control of a lot more money to be able to take a significant enough position in the market to actually make a profit. Obviously, 1 to 500, you can do the math. So the broker is lending us money, and we put up collateral or a down payment, you can consider it. All right, this is the money we put up to be able to trade this amount of money. And that is our margin. Margin is the amount that you had to set aside in order to use the leverage that is offered to us. Okay? So in using leverage and using margin and taking a position in the market, we use what is called a lot size, a position size in the market that we take that is dependent on our stop loss, the size of our stop loss, as well as our account balance. Okay? So the standard lot size in the market is what's called a standard lot. It allows us to take control of 100,000 units of whatever currency we're trading. Okay, so a standard lot denoted by 1.00 as a standard position size, a standard lot size in the market yields us $10 a pip. So if we're buying a currency pair and the currency pair goes up by 1 pip, we have made $10. If it goes up by 100 pips, we've made $1,000. And obviously vice versa if it goes in the opposite direction. If we buy it and it goes against us 1 pip, we are currently $10 in drawdown in the negative. If it goes down 100 pips, we're $1,000 in the negative. Okay, 2 standard lots, $20 a pip. 3 standard lots, $30 a pip, and so on and so forth. Obviously, the more money you have in your account, the more margin, leverage you have, and the higher position size, the higher lot size that you can take within your position in the market. Okay, we're going to step down now to the mini lot. Allows you to take control of 10,000 units of currency, which is denoted by a 0.1. If you use a 0.1 lot size within the market in your position, it yields you $1 per pip. So if it goes up 1 pip, you're up $1. If it goes down 1 pip against you, you're down $1. 0.2, and obviously these are multiples of the mini lot, the 0.1. 0.2 would yield $2 a pip. if it goes in your favor. Obviously $2 a pip if it goes against you. So on and so forth. Down the next level is the micro lot. 1,000 units of currency you can control. So a regular mini lot, a 0.01 lot size, yields you 10 cents per pip. 0.2, 20 cents a pip. 0.3, 30 cents a pip. You get the gist. Okay? So that is essentially, right, how we take position in the market using lot sizes. Lot sizes allow you to make use of your leverage and apply your margin and actually make a profit in this market based off the minor fluctuations in the exchange rates between currencies. Okay, otherwise, we would need hundreds and hundreds of thousands of dollars to be able to make any type of significant profit in this market. And that is the beauty of leverage, the beauty of putting up margin. Okay, so the standard lot, all right, for most pairs, or I should say for the major currency pairs, does yield $10 a pip. And it depends on the base currency pair, right? So the second currency within the pair determines the actual monetary value of a standard lot or of a mini lot or of a micro lot. So certain pairs that, just for an example, if it ends in Canadian dollar that you're trading, a standard lot would typically only yield about $7.50. You don't need to get much into it as to the why. But essentially, a full standard lot would not yield you $10 a pip. It would yield about $7.50. So you get about 25% of that. JPY, if it ends in JPY, it's about 90% of a standard lot is what you would actually yield. Okay, and if it ends in an NZD or an AUD, it's about 66% of a standard lot. If you use a standard lot, you would get about $6.6 per pip. Okay, don't need to get too much into it because we will show you a tool that we use to give us the exact lot size that we need to use within the market, within our positions. This is just to give you an overall idea and perspective into how we can actually leverage our money by using margin and leverage to be able to take a significant enough size or position in the market to actually make a profit. Okay, and it's denoted by our lot size. Whatever lot size we are using in the market determines our yield per pip. Okay,